All right, everyone. We're launching our new podcast series, and I'm super excited because our very first guest is Mark Milan. Anyone who has been watching our channel on YouTube will know that Mark Milan was my mentor, my friend, my business partner, the person who taught me that I could build wealth through real estate. This was not something that I learned in books. This was not something that my parents were unfortunately able to teach me. But watching Mark build wealth firsthand, being able to assist him, learning from him, asking tons and tons of questions, I realized that I could become a millionaire as well. And it's interesting because Mark, so that was something that you taught me, and now years and years later, I feel like I'm teaching people via the podcast that we're just launching now, but also obviously YouTube, which is a very popular channel. So, Mark, thank you so much for being on today.
Absolutely, my pleasure.
Mark, talk to us about. So let me just give a quick background for some people who don't obviously don't know Mark, but Mark is out of Long Beach, California. He has been investing in real estate, I'm going to say, for over 30 years. He has owned hundreds and hundreds of apartment buildings, single family homes, commercial buildings, hotels. He's built the self storage. He's sold the self storage. He's done smaller development, built a lot of ADUs, was the first in Long Beach to do a factory built ADU, which at that moment he had to teach the city of Long Beach what they were, the process, and really made it easier for anyone. He was the pioneer in that. So anyone behind that probably came after. So Mark has tons and tons of experience. Oh, I didn't mention he's an MAI. So he's kind of the top echelon when it comes to appraisal services, doing a lot of commercial appraisals. He's a licensed contractor, has his MBA, and has taught at the community college level. Mark loves to teach. He's a great teacher, and he simplifies the process. So that's a little bit about Mark. Mark, the question that I want to ask is, you didn't come from wealth.
Absolutely not.
Who and when, who taught you, and around what time period did this, you should be investing in real estate?
I think it was when I went to grad school. When I went to grad school, I happened to stop by a friend's office, and I read a term paper. I was doing 2 or 3 term papers a month in grad school, and I read this term paper, and it was actually a 80-page paper on a parcel, what it was there, what should be there. And as I read this full commercial appraisal, I realized, oh, dang, this is exactly it's just a term paper. And at the time, I think these are a long time ago, you get $5,000 for looking at a car wash or a site that could be a car wash. And I thought, I should do term papers for cash. I think I'll become an appraiser. So it was a foot into appraisal that really got me going. Now, at the same time, I guess my daughter was graduating from college, and we decided to sell a big house in Orange County and move into Long Beach to buy a house with some units. And then I started experiencing both in real time owning rentals at the same time as doing these term papers, becoming an appraiser, going all over the country, taking Appraisal Institute courses so that I could earn the MAI designation. And it's knowing that highest and best use that really turned me on.
Mark, if you recall, how old were you when you bought that first triplex? And if I remember, it's the one on Molino, right?
Yes. Okay. We'll say 28, maybe it was more like 32. I was a late bloomer.
Okay. Yeah.
Late
I mean, some of our followers are getting started in their early 20s.
Yeah. What a gift to have the compounding value starting younger. I wish I could have, but I didn't know. And I was poor and I hadn't figured it all out. It took a while to figure out how to raise the capital, how to do a project, whether you buy it or you sell it. There's a lot of decision process, and it was nothing taught to me. It should have been taught to me in high school, along with how to balance a checkbook and the evils of credit cards, but they don't teach you that stuff.
Right. Mark, when you were doing appraisal, and I remember you telling me, hey, Juan, I realized that I'll let you tell the story, but it was something along the lines of if you do appraisals, you just get paid once. But if you're the actual investor buying the property that you are appraising,
Right.
you get paid forever. Why don't you, because it seems to me, just because I've known you for so long, that is like the one part was like, call it like the light bulb moment, maybe that I thought maybe happened with you.
Yeah, correct. And there's a difference between income and wealth, and that's the thing that it took. I had to get to grad school before I figured that out. You could make $200,000 a year, but by the time you pay your taxes and all the fancy suits you need to be working at, and the paying for the parking, $300 a month downtown where you work at the fancy job, you end up with really no retained earnings. And I thought, oh, instead of making a lot of income, I wanted to figure out how to make a lot of wealth. You need enough income to pay the bills. Truthfully, my formula was it takes 40 hours a week of hard work to pay for your housing, your insurance, your food, your life. So if you're going to get ahead, you need to work the other 20 hours a week. And if you're working that other 20 hours a week, then all that money can be investment money and can be play money where you're constantly rolling and turning it. And that's what I did. I used to always work a 60-hour week.
Mark, talk to us after that first triplex. And listen, I know the backstory. It wasn't easy, and you tell the story of at some point you thought it was a loser.
Well,
And
absolutely.
and I'll let you walk through. Tell us about that, because it's not always a straight line up. And you've seen cycles. I mean, I've heard the stories, and
Yeah.
where you'll point out properties. You're like, Juan, they couldn't give that property away. And obviously now in 2024, we're like, really? Because as we look back, we can't believe how far they've come. But what talk to us about Molino, some of the issues that you had, because the market did change at that time, and then what got you going again, and what were the signs to let you know this is time to buy again?
Well, with that first house with the units, it was really bought to flip. At the time, I wanted to buy low, make it higher priced, increase the rents for the tenants so the value goes up, and then we would sell it and maybe get a little something nicer.
How much was the property at the time when you bought it?
I bought it for 3.25.
Okay, so 325,000
Yes,
for 3 units. And if anyone knows Long Beach, this is Belmont Heights.
right.
Correct.
And it took me about a year because it was the first time I was rehabbing, and I was also doing appraisals at the same time for fee income to fix up the house. I mean, the house was been a rental for decades, so it was really abused. Uh, but the market changed, and I went to sell it, and all I could get was what I paid for it, and I wasn't willing to write off a year's labor and all of the investment cash, and so I kept it. The nice note is I still own it today. It's worth about $1.7 million, and it creates about $5,000 a month to the positive. So I mean, it's a nice error to have made.
Right. So the thing is that you didn't want to realize the gain. No, you didn't want to realize the loss.
Right.
You kept it, even though you probably would have just maybe broken even. But had you done that, you wouldn't have gotten this wealth creation that one specific property gave you.
Exactly. And once you hit that, then you realize, oh, okay, I can do this more. I can do it in other neighborhoods. You want to know where you're investing, and there are strategies on that. The guys that buy stuff in Utah or Nevada, Arizona. Mine is more of a investment theory where I want to drive by and kick the tires. I like taking a bike ride and driving by a dozen properties that I own. To me, that's fun. In fact, on my last trip, I was just through skiing in Italy. I was excited to get home, and I realized that I don't have a boat and I don't have a plane, but I have a bunch of toys, and they all seem to be income-producing properties. And it's so exciting to come back and see my properties. I'm more of a hands-on, small-time guy. I like to see what's going on. I want to know. I don't know all my tenants, of course, because I have staff. But the truth is that is the exciting part in my life, is to come back and look at my toys and see what I want to do. And this needs a paint job, and that needs a roof, and just make a list of things that can get done later this year.
Mark, when I met you was 2000, call it 2002, maybe 2001. I was still in college, but you were rapidly buying a lot of apartment buildings in some of the tougher areas of Long Beach, and you were repositioning them.
Right.
Talk to us about why were you doing that at that moment? I mean, at this point, you've years and years of appraisal, so I think maybe you got comfortable with analyzing properties, figuring out from the people before you, like what was it that made you want to get started?
The business cycle changes. It's a business cycle, and real estate is no different than any other industry. You have cycles. Okay. At that time, banks were being foreclosed on by the government. There were so many bad loans coming back. They created something called the RTC, the Resolution Trust Corp, and they would auction properties. They put them up for sale, and so they were all available. But because the banks, you see, everybody waits until the interest rates get too low or something. There's a motivating trigger where you should just be buying all the time anyway, and I can tell you about that. But the important thing is that the banks weren't making loans on properties. They were selling the properties that they already foreclosed on. And nobody really knew where the bottom was. So if they sold it at a loss and wrote off the first loan and now had a new loan on that property and had to sell that one at a loss in a year, I mean, that would be really stupid banking. So they sold them off. And I realized at that time that there weren't that many people with cash. So I assembled a group of different people, of investors, and raised the cash. Not a lot, but raised the cash to actually go out and start buying these properties. At the time, there was another niche that you notice because everything's cyclical and there's always one or two power niches going on. And I might, like right now where people say, oh, overbuilt office space, turn it to condos. Well, that's a niche that somebody could do if they're a big developer. As a small developer, small contractor, I was able to buy 5 and 6 unit buildings and turn them into 4 unit buildings. And I would do that essentially by, let's say, taking out the wall between the 2 1-bedrooms. Well, that gave me an extra kitchen that was a bedroom now. It gave me an extra living room that was a bedroom now. And next thing I have a 4 or 5 bedroom, 2 bath. I noticed at that time that those rented first because nobody built apartments with 4 and 5 bedrooms. And all of these families that are a lot of immigrant families coming over, a lot of people, but nothing was available for them of that size. And so those rented first, and then the 2 bedroom, 1 baths, et cetera, and the rest of the complex would rent up. The idea was that I didn't care about a loan at 10%. I would take out a loan at 10%. And back then, maybe it was a 6 or 7% market. And I'd take out a loan at 10% knowing that I was only going to have that loan for 1 year.
You're saying that the interest rate was 10%.
The interest rate for what they used to call hard money. I call it private money now.
Okay.
Okay.
You don't like the word hard money.
No, it sounds too desperate.
Got it.
Okay. It sounds like I got to get a loan tomorrow or I lose everything I have. And that's bad stuff.
Yeah.
And my investors always got all their money back and they always invested again with me or lent to me again. And I still have a great lady who actually lives like a block away from me who was one of my original investors. And she constantly, when I give her back her money, she always says, well, give me something else to put it on. Mm-hmm. And she doesn't want to manage of this stuff. She doesn't want to be a partner. She just likes the fee income. And when you're really good at paying people on time, the money is not a shortage.
Mark, so it sounds to me like you were buying at a time that no one else wanted to buy because the market was pretty bad. And so maybe some people thought you were not wise in buying, and maybe they thought you were definitely not wise because you were taking out 10% interest loans. But that wasn't scary to you because you knew that there was an exit plan. But the exit plan was get the property low enough, renovate it, and then sell it at a profit because now you've changed the income. Mark, one of the most important things that you've ever taught me is the higher the income, the higher the value. And so we've always gone through different examples of like, hey, Juan, if you raise the rent by $1,000 per month, so that's $12,000 for the year. A lot of people would think, hey, your property has gone up, and it's just kind of simple. Like, well, my property went up by $12,000 because I increased the income. But early on, and I was in college, you're like, no, Juan, that's not how it works. Everything sells on a multiplier. And you need to figure out what the multiplier is for the area. But you take that 12,000, you multiply it to said multiplier, whatever that could be, and that's really what you made. And that's where I'm like, aha, that's where money's being wealth. But like, talk to us about, because your strategy is simply, and it's not simply. I mean, it's very tough. Hey, you need to buy smart. You need to do the right renovations. You need to increase the income, but talk to us about the importance of understanding that the higher the value, or the higher the income, the higher the value.
Okay, and we use a annual income multiplier, or as some people call it, a gross income multiplier, GIM, because everything trades. Even stocks. If you read the Wall Street and you look at the different stocks, and they talk about fast food restaurants selling it so many times, it's next year's annual gross income. Everything sells on a multiplier. So when you, in your example, when you raise it $12,000, well, what's the multiplier in the area? And it's very easy to figure out. go look at a couple sales that have just happened, see what the sales price is, know what the income is because it's in the MLS, or you can knock on doors and figure out what the income is. Like as an appraiser, you did knock on doors and people tell you what they're paying. So once you take that sales price and you divide it by your annual income, then it comes up with this multiplier.
Yeah.
And you might be in a 10 multiplier neighborhood. You might be in a 20 multiplier neighborhood. It seems to be nothing much higher than 20 and nothing much lower than 10. So it's somewhere in that spectrum. You know that from the other properties nearby. You come up that multiplier, and now all of a sudden you know if you raise it by 10,000, it's a 10 multiplier neighborhood. You're up $120,000 in net worth or equity.
Correct. It's not rocket science.
You know, a little bit of door knocking and a little time you put into it, and you'll know exactly what that multiplier is. And to be less specific, you could actually look at the MLS at 30 properties that have sold in that city in the last year and just average all of those. And you at least have a rule of thumb to go by. But I like to knock on the doors in the neighborhood. It also gets me a flavor for what it is. Again, I'm going to know the property. And I typically don't sell. I just collect them. That seems to be what people say. What do you do? And I collect small properties.
Got it. Mark, when did you realize, like, and whether it was a year or how old, when did you realize, oh my gosh, I've actually made it? And Mark, was the goal to become a millionaire, or was the goal to have passive income? Because those are the two things. Was the goal to leave a nest egg to family? Like, what was your driving motivation? Because everyone's got a little different, but they're not that different. There's almost like 5 things that people say. Hey, I want time. I want freedom. I want to be able to retire. I want to be able to leave something behind. I don't want to be working for the man. So there's all these things, but there's not that many things. What was your motivation? When did you know that you made it?
Long after I had made it. I'm going to tell you.
Long after you made it.
I made it 10 years before I realized that I made it. And I went to my bookkeeper, who's been with me for 20-some years, and I go, God, I'm just tired of being poor. How come I'm poor? She goes, you're not poor. You're really rich. And I go, how come I don't have the $100 bills just flying out of my pockets? And she goes, well, you keep buying properties and you keep using all of your excess income to put down payments and rehab expenses into your properties. So you're still rich, but you don't. So the answer to the question is, I think it was my bookkeeper who told me I was rich when I figured it out. I always saw the net worth growing up, and I remember one time, years ago, it was so cute. My net worth shot over $10 million, and you called me a decamillionaire.
Mm-hmm.
Priceless.
Yeah.
At that time, I really knew for sure.
Okay. And I'm sure now it's much, much higher than that because you've been consistent with continuing to buy.
Absolutely. And the amazing thing is that if you just buy regularly, whether it's once a year or once every 2 years or something, if you keep buying, pretty soon you've got this property portfolio. And let's say, for just example, that your portfolio was $20 million of value. It doesn't mean you have the $20 million worth of net worth. It means of total market value. Appreciation runs between 8 and 12% over time in our market. Mm-hmm. But let's just, for easy math, say 5% return. Well, 20 million, that's $1 million a year. $1 million a year of net equity being increased, not because you're out slaving in the ditch laying the pipes, but because you own and manage the asset.
Mark, I'm glad we're talking about appreciation, and then I'll bring up cash flow as well. A lot of our channel, sometimes people get upset at me because they say, because I'll tell people, hey, this is a good deal, and they're going to look at the cash flow and say, hey, that doesn't pencil, that doesn't break even, hey, that's slightly negative, I'm not going to buy it for those reasons. And I'm like, well, you realize that if you buy this property, it should go up conservatively, maybe 60,000 for the year. And so although you're seeing a loss of 12,000 from a cash flow perspective, you're actually you're missing out on the opportunity of 60,000. And they're like, oh, there you go again with appreciation. Like, they hate that. Like, they're so impatient for that. But you're here telling me, as someone who's done it for decades, that that's how you made it as well.
Absolutely.
Help me explain to our viewers, to people who tune into us, how do you look at deals when it's, hey, the cash flow, it doesn't pencil, Juan, why would I buy it?
There's a big question. Why are you buying it? Okay. Are you buying because you like the neighborhood? Are you buying because you've got 2 or 3 others on that vicinity that you're going to be making your management easier because you can walk between the different properties. There's a lot of different reasons to buy. Of course, the cash is important. It doesn't need to be the only one, but the cash is important. And appreciation happens. It just happens. Even when we went into a recession, well, it wasn't quite a recession. Like it was a couple months of depression in 2010, 2011. So things didn't go up. The only people who lost were people who sold in the down market. All they had to do was wait another 3 years, and it was worth way more than whatever they bought it for. And now they're in a positive cash flow business. It's really tricky about buying properties that are negative cash flow. And sometimes that's not good unless you have a lot of other money coming in from stock, royalties, something where you want to work to have the negative cash flow is good for you because it's also a deduction. I like to not buy on the negative cash flow. I want to know everything I buy in 1 year is making money. So when I buy it, I have a plan that in 1 year it's positive cash flow. Sometimes it's 3 months, but always 1 year.
Okay. And I tell people give it 18 months, but there has to be a game plan. And when I say game plan, it's just what's your business plan? Because I'll tell you this, Mark, and this is, I learned a lot of sayings and quotes by spending a lot of time with you. But one of the things that I created is that the income of today is not the income of tomorrow. Because
Absolutely true.
here's the most interesting thing, Mark. People look at a deal and the cap rate's not high enough, okay? And I need to remind people, hey, the cap rate is a snapshot of the next 12 months. You're going to own this how many years? And in most cases, it's like, 10, 12, 15 years.
Exactly.
So you're going to make an investment decision because you don't like the snapshot of 1 year. Did you not look to year 2? Did you not look to year 3? And so most times, listen, here at our office, we're analyzing deals, like 10
Sure.
deals a day. I mean,
Yeah.
especially with all the agents we have. And most times they're not money makers yet, but we need to make them money makers. And that's why working with us, we teach what you taught me. And it's how can we bring more value? How can we make this building better so that a tenant's willing to pay more? And then we've changed the income. And voila, you change the income, whether it's 12 months, 18 months, 24 months, you change the income, you change the value, and now you're in a better cash position.
Absolutely. The future is why you're buying it. It's the future value of cash. When you look at what it's going to be and then you look at what you're paying today, most times it's fair what you're paying today. In fact, I've learned through hard lessons to pay too much. I lost a beautiful former Beacon storage building that is now self-storage by $15,000 because I got too tight. Another time, I lost another property. It's like, if you're buying, let's say you're buying $1 million property and your bid is $950 and someone else is at $1 million. If you went to $1,050,000, so what? It doesn't matter. First off, you're probably financing some of that, so it's not like you need it in your right away out of your pocket. The kids aren't going to go hungry at home. More importantly, the $1 million building in 10 years is going to be worth $2 million. Who cares about the $50,000 too much that you voluntarily ripped yourself off for by paying too much? It's like, get the asset. If you want the asset, get the asset. You'll figure out a way to make it. The income will continue to go up from the tenants or whatever you're doing with that building. And maybe that doesn't work in a lot of instances for institutional investors. But I'm talking to you about guys that have $0 or $20 million. And that's where we got to not worry about the going in interest rate, because we know we're going to refinance it. It's going to be worth a lot more, and we're going to get a better rate as the income goes up. The cost of rehab has to be a consideration as well. If you're going to buy something for $1 million and it costs you $100,000 down to reposition that property, that has to be in your cash flow as well. Otherwise, you're not going to get the increased rents that you might be planning.
Mark, one of the things that I hear, I guess this is more like seller based, is we don't like the statewide rent control. We don't like the direction that California is going. It's time to sell, and then they really poo poo a lot on California. But then I'm like, and typically I encounter this because I represent a lot of sellers who a lot of them seem to have the same thought process when it comes to that, and I'm like, thanks to the well, and typically they own 10 million, 12 million. There's $30 million worth
Right.
of California real estate
Right.
that they're now hating on.
Yeah.
And so I guess my question is, you continue to buy and invest in California, and what are your thoughts about, like, I mean, some people are saying, hey, it's going downhill, don't invest here. How do you see it?
Uh, it's a golden state. It's always been the golden state, and investing in California just makes sense. We have appreciation, we have population, and boy, do I hear the stories about how we have a net outflow of people. So get on the 405 freeway at 5 o'clock and start guessing about how many more people you'd like to have move out of state. Uh, I don't see it. I'm not affected by it. It may hit some tertiary markets, but as far as the primary markets, there is more demand than there is supply, and that's of commercial properties and of residential properties in our local area. And that's what you want to be, as a sharpshooter of your area. Don't buy one 50 miles to the east and the other one 65 miles to the north, and you can't see them and you can't touch them, and you don't know what's going on in the neighborhoods as far as what city might be doing rehabs of their own town center, making them more popular. Long Beach has had billions of dollars dropped into it in the last decade. It's phenomenal when you think about the convention center and the aquarium of the Pacific, and it just goes on and on. And downtown, there's so many new buildings that are 4 and 5 story apartments on top of retail. It's just mind-boggling how much money has come in, and these apartments are filling up.
Hey, Mark, we talk about, we read in the LA Times that we are losing a small percent. It's a very small percentage. I mean, like, they'll say, hey, this year California lost so much, but what people don't know is that we've been losing a population for the last 30, 40 years, but it's been very small. But the one part that I kind of want to get into, because I know you're going to be familiar with it too, is we might be losing a very small percentage, which is called like 1% or less than 1%. But we're gaining, and the LA Times calls it the brain gain. Talk to me about the brain gain. I haven't done a video on it yet, but it's so powerful. And tell me what you know about it, and I'll kind of give you my thoughts.
Okay, it's just where the success and the money goes, and so then you end up with a more professional clientele, or more educated. You can look at the blue-red map. You can see who's the educated, who's not the educated, and where the great successes are. And I mean, even if you go into a red state like Texas, you go to San Antonio, and all of a sudden it's very popular. But now I just read in today's Wall Street Journal that Texas is now overbuilt and prices have stabilized, have started to decline. So the whole dream of leaving one area to go to another area doesn't make sense. I mean, but if you like to golf more and you're retired, then going to Arizona might make a lot of sense. But I wouldn't take my family's roots out of this area and go to another one just because of a perceived loss of population, which I can't find the effect of.
Right. No, and I would say that it is perceived. So the brain gain is people from Michigan, Idaho, Ohio, Iowa. All these states come out with really good degrees, and engineers, software engineers, and they're looking for, hey, where can I get a better lifestyle, and where can I get a job that's going to pay me well? And California seems to fit that bill. And so the brain gain is, while we might be losing population, and in some cases, yes, they are retirees. In other cases, they're lower economic, that simply can't afford to stay here, but they're being replaced by professionals with degrees who then look for rentals that you have, Mark, and I have.
Yes.
And you know this, you and I own a duplex down the street, and we have, I mean, we had 2 doctors living in,
Yes.
and then when they moved out, it got replaced by another doctor. And we keep thinking that's part of the brain gain. They are not originally from California. And so the way that I look at it, Mark, is when you buy an apartment building, you're buying a business.
Right.
You're buying a business that you don't have to go to every day.
True.
Right.
Exactly.
And it's a business that the day you close escrow, if you had a vacancy, I promise you there's going to be people contacting you without you putting out a for lease sign. I think people don't sometimes, I'll sell, like I'm selling a fourplex this week, and it's in Los Angeles, and it's going to be delivered with 1 unit vacant, which is huge, right? So
Right.
it's a very, very big positive thing. And so um, the buyer, sweet lady, she said, is it going to be hard for me to rent this out? And I started laughing. I'm like, oh, you have no idea. You have no idea, like the 100 people that are going to show up to rent your property because there's that much demand. And so, Mark, I tell people, if you're fortunate enough, and listen, I know we're simplifying this on this thing, like, hey, buy one every year. People are probably thinking, well, where the hell do I get the money to buy my first one, right? And
Right.
and we'll get into that too.
Okay.
But the thing is that once you realize that how much demand there's going to be for a vacancy, once you realize that there's 20 qualified tenants that you would love to have, I don't know. I always get the thought of like, oh my gosh, I have to choose one. They're going to be great tenants, man. But what about these other 19? I want to house them too, right? So how do I do that? I guess I got to go buy more properties.
No, exactly.
But
No, I've got the same thing where I just did one, and the two ladies wanted it, but I gave it to somebody else.
Yeah.
But they were perfectly good. I would love to have had these two ladies, and they came by even though the sign was down, and they said, oh, is it still possible? And I said no, but then I could refer them to another vacancy that I'd just gotten, and they went out and looked at it. And if you do a nice job, the people like it. This particular neighborhood that we're in, when you're a block or two from the beach, is really high demand, and you get people that have a lot of income. So when you have a higher rent, it doesn't seem to bother them so much because they have more income.
yeah, no, I completely understand. Mark, talk to us. Listen, you taught at the college level. You're great on stage. You're a great instructor. Someone's listening to this. Let's help someone. Let's coach someone through maybe buying their first fourplex.
Great.
They just came out a few months ago that they made it. Fannie Mae adjusted their loan requirements. So if you are a first, well, no, you don't even have to be a first time. You could essentially buy a duplex, a triplex, or a fourplex with 5% down. One condition: you had to live in one of the units. Which, by the way,
Sure.
that's what you did, Mark.
Yes,
I mean,
absolutely.
maybe not through the Fannie Mae program, but you
No.
bought
Yes.
you bought a triplex.
Yes.
And yeah, listen, it's a single family home with a duplex, but it's one parcel.
Right.
It is a triplex in my
Okay.
opinion. And so you did this.
Right.
It worked for you, call it 30 years ago, 40 years ago.
Yeah. Yeah. Forever ago.
Can it work now? How, like, talk to us for the person who doesn't have their units yet, but maybe they've been saving up, and with 5% down, the interest rates. So here's what they're going to tell you. They're going to say the interest rates are high,
Right.
and I'm going to be paying more than rent. Why would I do this? What do you say to
Perfect. Well, you get a tax benefit that's gigantic. You've got the mortgage, and you have the property taxes that you're paying. So that is a great offset that you see in your second year. You don't see it in your first year because you haven't done that yet. So you'll see that in your second year. Additionally, your rents will go up every year. So if you just did a 5% increase on your rents, that will assist you, and it changes the cash flow for the second year. Some people have not had their rents increased for a long time, and you can increase their rents immediately to whatever the maximum is. I think we're about 8.8 right now, or something like that.
8.3.
8.3. Okay. The economy keeps getting better, and the amount and the inflation keeps going down.
Yeah.
So the amount of money that we get to increase our rents is less. I typically don't do the max anyway. But the point is, go buy it. Go find the property. Go buy it. It's $1 million, and you don't have enough money. Get a partner. Get a partner. There's no shame in that. You could have a good buddy. If you can't do business with family and friends, you shouldn't be doing business. That's always been my motto. So ask a dad or a mom to come up with matching amount down payment. Okay. That would double the amount of money you have to put down. If you don't have that, well, who are you carpooling with? Who are you going to Carl's Jr.'s with at lunch today? Talk to those buddies, each one of them. Get 10 grand out of each one of your 3 buddies. That's your 30 grand plus the 30 or 40 you already have. Now you're talking, you got 5% down for $1.2 million property or something like that. It's doable. Just do it. Now, yes, you're going to need some paperwork, but you don't need a fancy attorney to draw up a $10,000 agreement for you. You just write down what it is in simple terms, who put what in, what their percentage of owner is, who's going to be the manager, who's the responsible party. Just simple things. You sit down, and when you can you can do it with a notepad and a couple beers, and you come together. Now you got a syndicate, but you're really just partner guys, and you're doing this stuff together. And it's nice to do it with partners. It's fun to share the ooh and the ah. It's nice to share profits, of course. It's nice to have distribution. Every time I bring over a distribution check for you on, I'm happy. I'm thinking, dude, look at this.
So for the listeners, Mark and I own several buildings together, and that we bought through the years. We still own them, and it is nice when Mark will bring a check. Oh, okay, he's bringing me a check because the property is positive cash flow. So reminder that didn't happen year one or year two. This was, I mean, we've owned them for so many years now so I just tell people to be patient.
Right.
When it comes to the cash flow, you really don't have to be patient for the appreciation. I mean, life goes by fast, and before you know it, it's 5 years later, and oh my gosh, it's gone up by 300,000. And I know that we simplify it, but that is all I've seen.
Yes,
Mark, for the person who's buying,
for the listeners out there, if you're in Topeka, it may not work the same.
Right.
If you're in Cincinnati, it may not work the same. Okay, you've got to know your market. Okay, we're sitting in California and thinking, oh yeah, California is the Gold Coast, and everybody wants to come to a coast. But some Californians move over to Florida because they want a different coast. But know your local market. Know your local market. You can find it. My daughter has income property, and her tenant comes out of Cincinnati, and that man, they just have the apartment to vacation at. That man owns a nice house and 75 rental houses because he bought all these rental houses for $10,000 and $25,000 a piece because they were foreclosed on and they were dumpy, really bad condition. But he would buy them, fix them up, put in a tenant, and if the tenant is paying $1,000 a month, that's $12,000 a year. Mm-hmm. And the guy, even if he paid $35,000 for it, it's like a 3-year payback. That's the same as a 33% rate of return. So find the deals. What's going on in your market? Every market has something special going on in it, and that's what you have to analyze and jump on.
Mark, thank you for that. Talk to us. I know you've been building, last couple of years, you've been building ADUs, accessory dwelling units, which is so in California, and this is not every state, they're allowing us to either convert the garage or the backyard, build another dwelling because why? We don't have enough housing. Talk to us about the importance of building ADUs, but also kind of the economic drivers. Like, I mean, clearly it's making money. Otherwise, you wouldn't be doing it.
That's true. But it's when you're making housing, it's a noble cause. Mm-hmm. Okay. It's something really important that you're doing, especially if you're taking someone's backyard, which really has no purpose to it. It's somebody's paying $100 a month to a gardener to maintain it, perhaps, or slaving every other weekend on it themselves. And you put a house back there, you've made more housing. And to me, that is rewarding. It's just psychologically rewarding. Now, as far as financial, sure. If your ADU costs you $250,000, your house goes up about $500,000, and you've made $250,000 new equity just by putting another house in the backyard of what was a rental house to begin with. So the money is there. It's absolutely a moneymaker. I can't understand why the state just doesn't come out and fund everybody with an ADU. Let everybody who has a backyard big enough, who has the desire to have additional income, just fund it for them and create the housing. I look at these articles where the housing in like Los Angeles just put up a big high rise for the homeless and the unhoused. $600,000 a unit is what they paid to get this building converted into it. I'm going to give you a 3-bedroom, 2-bath home for $250,000 or $300,000 in your backyard. Right. It's like, and it's worth the value of the house. And so there's so much money to be made in it. The question is how hard do you want to work? If you want to work really hard, if you're making $200,000, $300,000 per ADU, and you did 5 of those in a year, that's $1.5 million of untaxed equity. So it's there. It's very easy. It's just doing it.
Mark, we're going to be wrapping up here in a little bit, but I wanted to get your thoughts. For the folks listening to us, they're going to say, is this still a good time to buy? Are you still buying, Mark?
I am still buying. It is a good time to buy. And Do not be afraid about the loans. Okay. Our friend Caleb has that horrible, horrible sale that you're marrying the property, but you're only dating the loan, because as soon as the rate changes, you're going to go out and get a new lower rate so your payments will drop. This is the time to buy because some people are sketchy and afraid of it. And so just pull the trigger. Just go buy. You're not going to go wrong. The market's not going to crash. There aren't so many people who are going to move out of California that the house has no value because nobody wants to be here.
Some of the things that I'm going to say on behalf of the people who I talk to is, hey, Juan, there's a recession, there's an election year. I don't know who's going to win. This is just a bad time. The interest rates are high, and Juan, the value's never dropped. Why would I buy?
That's right. The values aren't dropping. That's why you buy. That's why you buy. I swear to you, I was in my house for like 5 or 6 years, and some lady walking down the street, and I'm sitting on the porch, and my wife is doing some gardening in the front yard, and the lady comes down the street, and she goes, you got the last great deal in this neighborhood. And it was because she wanted to do it, but didn't pull the trigger. Okay. And so we got the last great deal. No, every time you buy, you just got the last great deal. And if you pay a little bit too much, don't worry about it. It will be completely covered over 10 years from now. You'll laugh when you tell your friends, no, when I bought it, I paid $25,000 more than what the listing price was. And everybody thought I was a chump. Mm-hmm. And I bought it with a 10% loan. But but 3 years later, now you're sitting with a 5.5% loan. It's making a whole lot of money. Just pull the trigger. Be smart about it. Do your research, do some homework, or use a broker who knows the market. And it's like your broker can't know what's going on in Seattle. That's a Seattle broker. Go talk to them. But if you want to know what's going on in Southern California, specifically this Long Beach, South Bay area, they'd be a fool not to call you. You've got more experience in this than most anyone out there.
Mark, thank you for the shameless plug. I appreciate that. With that being said, Mark, I'm going to give you the final say. If there's people who want to get a hold of you, if there's anywhere that you want to tell people to check out, anything you're working on, please let us know.
Very easy. I respond to emails. I check it almost every day now. That's about as high on my technological skill level I can go. But I am Mark Milan. That's MarkMalan @outlook.com. And drop me a line if you got a question, and I'd be more than happy to answer it. I don't take on clients now. I'm my one and only client is myself. It seems that I have less conflict in my life that way. So, but I do have a lot of experience, a lot of knowledge. I'd love to share something with you, especially if it's what you need to decide to actually pull the trigger, go buy something and be on it.
I got to share the story. So because of Mark's urging and him setting an example, and Grant, I have to remind people, like, this is not something that my brothers taught me, my parents taught me. I learned this from Mark. And so there was one time where, Mark got me going on my investment journey, and I had bought a condo. And then we bought a triplex together, Mark and I did. And then I was in a position where there was 2 really good deals on condos. And I said, Mark, then we were out to lunch. I'm like, which condo do I buy? And Mark says, buy both. And I was like, no, you got to be crazy. That's too much. I'm going to take too much debt. He's like, buy both. And I did. And I was able to sell one for a profit, like, really quickly. And so it's, listen, if Mark is willing to give himself, make himself available to assist you, he is, I'll always tell people, a lot of my education, my background, my motivation when it comes to real estate came directly from Mark. And so if anyone could learn from him and make him your mentor, you should take him up on that offer. So Mark, thank you so much.
Certainly.
Thank you so much for being here. You and I are still buying stuff. We're still looking at deals. Yes. And we're going to have you back again. Thank you so much for being our first guest. And until next time.
Good luck with your podcast.
Bye-bye.